In this chapter, we will talk about how economists calculate or estimate a country output in a particular year, how they assess the income of a country for a year. We're also going to look at a different way that economists evaluate the income. We will see how the GDP, the output produced, the GDP is adjusted of the price change factor, what we call inflation. Okay. And the last word of the chapter, explore what needs to be changed in today's digital age, right? And how the economists will need to measure output and inflation with the challenge of digital age, because a lot of things that we use today, even though those things improve the quality, our standard of living, the quality of life, most of them being free, it's hard for traditional economists to account for those into the output. So the content of the chapters will be how economists assess country performance, the different approaches to calculate GDP. We'll talk about expenditure approach as well as an income approach. We will look at other national accounts, make the distinction between the nominal GDP, right? GDP evaluated at a price that prevailed when the output was produced versus real GDP, the one that is deflated or inflated of the price change, adjusted of a price change or inflation. And at the end, we will review some of the shortcomings of GDP and bring the concept of the challenge of today, digital age. So the national income accounting does a similar thing that a private accounting will do for individual household or businesses, right? Assess the wealth of the business. So for macroeconomists, the Bureau of Economic Analysis is an agency of the Department of Commerce that compile all the data and report it into what we call national income and product account. Right, the information is used by economists and policymakers to formulate the best decision suited for the economy, right? The best decision that will promote the best interests of a nation. But one thing is to look at those data and use it to formulate a policy or advise that the policymaker will use to be able to change the policy or pass a law that will benefit to the entire nation. So the first item is the gross domestic product, right? That's the primary measure of economic performance, right? And that assesses all the output produced in the nation, right? In the country, but within a year, and those output produced, we monetize those output. So the output is produced is valued in dollars, right? Why is valued in dollars or valued in currency? To be able to make a comparison, we will show you why it's evaluated in dollars, right? Because of the mix of the good produced in the country. Okay, so the GDP is a monetary measure of everything that is produced within a country, right? The good and the services produced must be converted into dollar value for GDP to work. One thing to point out here is also you have to, since it's the output produced, the economy had to be careful not to multiple or double counting the good. To that point, GDP account for only the final good, right? The final good that was produced, and ignore those intermediate good. What I mean by that is, if you visualize the production at each state, a good of a transformation, something that you get transformed to another product. And that product will transform it to the next stage until you get to the final product. So if you count the final product, you don't need to count those intermediate product, right? Intermediate good. If it's a core, you count the value of the core, you add it to GDP, so you don't need to add the value of the tire, the value of the interior of the core, the carrossery of the car. No, so you wait until the final product and you account for it, right? By ignoring all those intermediate step in the process. Another way you can do it also to avoid multiple counting is just to count the value added at each step of the production process. Okay. So this gives you one good example of why the need of monetize the output produced, so that you can count it as a GDP. Why GDP is a monetary value of the output produced? Well, it makes sense. So if you look at this example here, so year one we produce, you can say that we produce 5 units of a good, right? Year two also we produce 5 units of a good. So if you look at it on the quantity, the output produces 5 and 5, but the mix is different. If you add the dollar or the currency tag on it, you will see that in year one, the value of the good produces 5,500, while year two is $7,000. So GDP is a monetary value because it will not otherwise be able to determine if the output has changed year to year, right? Because of the mix of goods and services that a country produce. So this example, this is a good example of the added value of in the production process. So this table give you example, simplistic example of 5-stage production. And when you look at it from A all the way to E, a different firm. And all these firms over here are in the production process. So if you say, for instance, for a firm A produce a good that was released to the market at 120, and that good, firm B had to purchase that good to be able to transform it to the next level in the production process. Here is a sheep, and a wool processor will get those sheep from the farmer and process it. And once they process it, they will sell it to the coat manufacturer. The coat manufacturer also all the way to the retailer, right? So you can see that if you want to account for the value added, you account for the value that you added on it. So that means that the selling value minus what it costs you to purchase the raw material to transform it to that product. So the firm B, for instance, our example over here, add only $60 to it because out of the 80, they had to take out 120 that they used to purchase the sheep, right, from the farmer, or you had to put the material from the farmer. So if you go to the coat manufacturer also, who have the final product at 220, they had to be able to remove the money that they spent to purchase those raw material from the wool processor and to process it to that stage. So adding the value added, you see that the final value or the value of the final good is still $350 compared to if you just adding it blindly at each stage of the process. You see that you might inflate the value, come up with 1,140. okay? And that 1,140 have a multiple counting into it. So two ways to do it is you wait until you get a final product, you account for the final product, that's what you add into the calculation of your GDP, or the value added at each stage of the production process. Okay. So what is included into the gross domestic product versus what is excluded, right? We say the gross domestic product account for all the output produced. So the non-production transaction had to be excluded from it. The calculation of GDP. There's a two main type of non-production transaction: the purely financial transaction and the second-hand sales. Purely financial transaction are what? Are the public transfer, things like a social security, and private transfer of payment, like you give allowance to your family member, a Christmas gift, all those things, people who are getting it are not adding anything to the production. We also have the stock market transaction, which is just a change of ownership, right? You take ownership and you change ownership. Those transactions doesn't do anything to the production, right? The second-hand sales, right? They don't contribute to the current production because that second-hand sale, probably that car, whatever you are selling with second-hand, we already account for that when it was new in the previous year GDP. So if you buy a used car or second-hand car, so that doesn't do anything to the GDP of that current year because no contribution to the current production. So how we calculate GDP? I alluded to it before, there's two different approaches to the calculation of GDP. The first one is the income approach that we're going to look at, and the expenditure approach. So the income approach look at GDP in terms of all the income that were derived or created from the production of goods and services. While the expenditure approach just measure GDP as the sum of all the money that we spend to buy those output produced. In theory, either of the method should yield to the same result, right? The expenditure and the income approaches are two different ways to look at the same thing, right? So we're gonna look at every single approach and see all the component of the calculation. So here we put it side by side, a visual side by side, so you can see the two different approaches to the calculation to measure GDP. The one on your left, which is expenditure, the most used expenditure one, you will see that accounts for all the money spent to purchase the output produced, right? The money that the household spend on the consumption, the business expenditure, so investment by businesses. We have the government purchases, money spent on good by government on goods and the services, right? And the last item is the expenditure by foreigner, right? Which is the export minus the import. On the other side, you have the income or allocation approach that account for all the income that were derived from the production of the good, right? Or those are all the income used in different input to be able to create or produce the good. The biggest one is the wages. And under wages, you have a salary. And the second one is rent. You add a rental. Third one is interest earned on the capital, and a profit from entrepreneurial ability. At the end, we have a statistical adjustment that we put here to be able to balance above. Each of these items will be further discussed throughout the chapter. So here is this table. I show you example of accounting statement calculating GDP for U.S. economy in 2018 using the expenditure approach. So you have the C, personal consumption, gross private domestic investment, business spending. You have a government spending, G, and the net export, which is X sub N. And if you add it together, you will have a GDP. Notice here that the net export for US is in the credit balance due to the fact that we import more than we export. And it's true only under good. For services, we export more than what we import for services. So this table calculates GDP in the United States for 2018 using income approach. So you have all the variable rolling into the income approach here, right? Note that the GDP total for both expenditure and income approach are the same. Come out with the same, the balance is the same, the balance. So now let's look at the different element or the different variable that roll into the determination of a GDP using an expenditure approach. The first variable is the consumption, personal consumption expenditure. And consumption expenditures, we spend money and good is indicated in the formula by C, right? And that covers all the expenditure by household on final goods and services during a year, right? And for United States, in a given year, approximately 10% of those expenditure on durable goods, and we have which is have a life of 3 or more. You can use them for 3 or more years, and we have a 30% of those expenditure go toward the non-durable good. Think like food, clothing, gasoline, and about 60% we use it on services. Right. So if you hear people refer to U.S. economy as service economy, it's because of the more than 0.5% of the personal consumption go towards services. Things like your car insurance, right? Your legal fee, right? Your bill that you have to pay in your house, right? All those services account for the majority of our consumption. So the second variable in the determination of a GDP using expenditures approach is the I sub G, right? The gross private domestic investment, noted as I sub G. And that what we have is that include the final purchase of plants, machinery, equipment, businesses, residential construction, research and development activity, the creation of new ore, new work of art or music, right? The change in inventory, right? The change if you add to the inventory or you reduce your inventory during a particular period, right? All these items represent where businesses invest in themselves, right? So investment, one gross investment exceeded depreciation during a particular year, you have the net investment, right? The net investment will happen because you have a gross investment, you had a consumption of that investment, what we refer to as a depreciation, right? So if the gross is exceeded depreciation, you have something left at the end of the year, which is your net investment. And the net investment expand the stack of private capital, from the beginning of the year to the end, right? And that allow economy, right, production capacity to expand. So now the last two component of the expenditure approach are government purchases, which is G, and the net export, X sub N. So government purchases are those expenditure on final good and services by government, expenditure on publicly owned capital, and that exclude, again, the transfer of payment, like we said before. One thing I want to note here, the net export, you add the import and you add the export and you subtract the import. That's very important because the export, we produce it and export it, we earn income on it. The import, other people produce it and other people earn income on it. So you have to add the export and subtract the import. That's very important. In this table, we compare the GDP for selected nation in 2017. And you can see that United States, China, and Japan have the largest GDP. Note here that all these country GDP were converted into US dollars using international exchange rate. Now that we talk about expenditure approach, let's review the income or allocation approach. Okay, and like we said before, the income or allocation approach, they have all the income, right? So that you look at all the income that people earn by producing the output. The major component of that is the national income, which is made up of employer compensation, right? Employer compensation, rent, proprietor income, corporate profit, taxes on production, and import, right? The largest share is employer compensation, which include wages and salary pay by both businesses and government, as well as those supplement that is including your salary package, things like a benefit paid by employer on behalf of the employee. So from the national income, right, we'll make some adjustment, right, from the national income. So under the income approach, all expenditure on final goods and services, right, that flow as income either to private citizen or government. So to move from the national income to GDP, we'll make some adjustment that we'll look at it later. The first adjustment will be is the net foreign factor, right, which is the income American, right, the national gain from supply resources abroad, right, And with that, we're also going to take the income that America will pay to foreigners by getting the resources from abroad. So the net of that, the next adjustment comes from what is called statistical discrepancy, which is basically a component to balance the amount, the expenditure, to balance both approach. Why we use statistical discrepancy is the fact that in general, people tend to underreport the income. Probably they earned the income a long time ago and they forgot to report it, or maybe because of for whatever reason, maybe because of the earning and it's not reflected on the W-2 form at the end of the year. So for many reasons, people tend to underreport the income. That's why economists use a statistical adjustment to balance it. So other income or other national account that you need to be aware of it, right? And all these provide insightful information to whether the economy is performing well or not. The NDP, which is the net domestic product, is the GDP less consumption of a fixed capital, right? And the national income, or NI, which is the NDP, the net domestic product, less a statistical discrepancy, plus the net foreign factor. The personal income, PI here, include all income received regardless of whether it is earned or unearned. And finally, you have the disposable income, which is DI, denoted DI, which is your personal income less taxes. After you pay taxes, what people refer to as take a home. So this table illustrates the relationship between the GDP, the NDP, the national income, the personal income, and the disposable income. So here is an updated circular flow that was introduced in early stage in the semester. However, if you look at the diagram, you can see that even when we account for more transaction in the economy, you see that the income and the expenditure are equal. Whatever we spend, right, whatever you spend on something, and that's the income that the producer will receive. Or technically, both of them, and what you spend is what the producer receives. So both should be equal, right? That's why you have the both approaches yield to the same result. By the fact that people tend to underreport the income, that's what economists use that statistical discrepancy to be able to balance it. So now let's look at the difference between the nominal GDP and the real GDP. The GDP, by definition, measure the production of at the current dollar value, right? So if you produce the output, you value those output in dollars, in the currency. So if you use it in the currency prevailing at the time of the production, is what we refer to as a nominal GDP, right? The nominal GDP is based on the price that prevailed when the output was produced. The other one, the real GDP, is the GDP that have been deflated or inflated, or put it this way, adjusted of the price change that happened during the production, right? So in order to calculate a real GDP, right, you have to determine a base year, or a year you want to use as a base year to be able to bring all the price to that particular year. So a base year must be selected, right? then the current year prices will be adjusted based on the base year. So we'll do one simple calculation of that later. So this formula I use to calculate the GDP price index and real GDP, knowing the nominal GDP. So we use the price index that is equal, right? Price index that is equal to the price of a basket in a specific year divided by the price of the same basket in the base year times 100. That's how you get a price index, the GDP price index. Now to calculate the real GDP, you take the nominal GDP and you divide it by that price index in 100 to be able to come out with our real GDP. So in this table, nominal GDP and real GDP are calculated based on the formula that I just showed you. So year one and year two have been calculated. So you can see here that it's determined that year one is the base year. Right? Year one is the base year, and that base year, the price index is 100. So based on that, you can use a formula to calculate the rest of the information, right? Year one or to year two, or here are all the output produced in each year. So you have the current price right here per year. So the GDP, the price index here, what we say is the price of a basket in a specific year divided by base year. This base year is year one, so it will be 10 divided by 10 times 100, right? So this 200 here is found by doing what? A specific year price of the basket in specific year, year two, divided by the base year, which is 10, to 20 divided by 10 times 100, they give you that. So if you follow the same logic, you take 25 divided by 10 times 100, you see this. So follow the same logic and check your understanding of how to calculate the price index. For the unadjusted GDP, what we call or nominal GDP, is the GDP evaluated at the price prevailing when we produce the good. So that means that the price prevailing in year one is 10. You multiply the 10 by the output produced, you have 50. 20 by the output produced 7, you have 140, right? 25 by the output produced, you have this number. So check your understanding to finish the rest. And how you get a adjusted GDP or real GDP is the nominal GDP divided by the price index in the 100. So you take this divide by 100 in the 100, it will be this divided by what? Divided by 1, right? So you will take 140 divided by 2, 200 divided by 2.5, and check your understanding to make sure that you grasp the concept correctly. So this table summarizes the two methods of determining real GDP in our singular good economy. In this table, show you the relationship between the nominal GDP and the real GDP and the GDP price index, right? So here the base year is 2019, and the price index, the base year is 100. So if you use the same logic, try to find the missing data, the missing information here. Year 2000, what is the real GDP? Year 2019, real GDP, and 1995, what is the GDP price index? We already alluded to some of the shortcomings of GDP. Why GDP is very accurate right? Reasonably accurate and highly used as a measure to assess the performance of our economy. It does have several outcomes, it does have several shortcomings. Certain productive activity are outside of any market system, so it's hard for the economy to be able to access to those data in traditional way. The value of leisure time, right? Today, in the past, people used to work 40 hours, 60 hours. Today, it's less than that. If you add the PTO and all those things to it. So we have those leisure time. How can we quantify those leisure time and add it to GDP, right? So those things are not included into GDP. Those quality time we have are not included to GDP. So if you look at it without that, you will say the GDP is under stated. Right. So another example under GDP is underground activity. So that people don't report, right? Rolling into the improvement of our standard of living, but there's no way for economies to be able to access to those data. So those are the things. So another example in the book is the cell phone set, for instance, the quality that we cannot access. If you buy a cell phone of $200 5 years ago, and you spend the same $200 to buy a cell phone today, it's a big gap in the technology, a big gap in the quality, right? But the value is still $200 that you add to the GDP, but because you cannot account for that quality improvement and add it to GDP. If we could, why GDP gonna be higher than what we report? So the gross output is another statistical measure that economists like to see. And this statistic is the sum of all the activity, right? They sum together the dollar value of all the activity that take place at each stage into which all economic activity can be grouped. So if you look at in 2015, for instance, the gross output to GO was for US, it was 31.5 trillion, while GDP for the same year, 17.9 trillion. So you can see that the GO is particularly useful, right? When you attempt to gauge the magnitude of a business cycle fluctuation in a nation. During the 2007-2009 recession, the real GDP fell by 2.4%, but the real GO fell by 8.6%. So what that means to you is that show how drastic or how heavy was the recession. I mean that the economic activity fell more than twice the GDP. So it's another measure, the GO is another measure that economists like to look at it to be able to gauge the activity in a particular economy during a particular time frame. The Bureau of Economic Analysis, again, the government agency charged with measuring GDP, has faced challenges in recent years due to the shift we are seeing in the economy, the digital age, because they face the challenge in factoring the changes that we see today into the calculation of a GDP. How do you value services that do not have no price? Like you go and use the Google search engine, right? And you use that add is a quality improvement. They add incremental quality improvement not just to the product, but to our life as well, because it saves us time. Just do all the research online before we go to the store. That saves us time. So those are the quality improvement, and also add to our time and add to improve our standard of living. But how can we access, or how the Bureau of Economic Analysis can access those information and add it to the calculation of GDP? That's a challenge they have. And so the traditional way of accessing those information and add it to GDP become obsolete versus the digital age, right? Because there's a lot of things doesn't have no price, so it makes it hard for people to account fully for GDP. So a new way had to come. We had to develop a new way, a new process in order to truly assess all the components of our modern economic output.